Welcome to Taking Stock for our final recording for 2025. What a year it's been, but more on that in a moment. But firstly, our heartfelt wishes go out to all of those that may have been affected by the atrocities occurred in Bondi last Sunday. Very, very, very sad situation, and our deepest thoughts and condolences for those that were directly affected. I'm Tim Lincoln, and joining me today is our head of Stock Doctor Research. Welcome, Kien. Great to be here with you, and what a year it's been.
It has, Tim, and great to be on board, Tim. And as you said, it's our last taking stock, and our holiday season is around the corner. But it's been a year of change, a lot, especially for the company, but also, changes in the share market as well. And we'll address that soon.
Yeah, all good, positive changes, Kien.
Mm.
New structure, new support around us with Prime Financial Group, so that's terrific. But also the share market, especially from a Stock Doctor Star Stock perspective, it's been a really, really positive calendar 2025.
Mm.
So as we do wrap up things for the year, it's fair to say, as I've just touched on, that it was a really strong year for equity investors. Returns were delivered despite ongoing volatility. There's always plenty going on from a macroeconomic perspective, isn't there? And
Mm.
all those macroeconomic shifts around the world have certainly caused havoc with our mindsets. But as long as we remain resilient and focused on bottom up stock selection, quality stocks, well balanced, diversified portfolios, at least 15 stocks, we've ridden through all of that macroeconomic noise beautifully. The All Ords also up around 9% for the year, so very strong. While in the US, the S&P 500 index jumped around 14%, Kian.
Yeah, some great returns there, Tim. But what really stood out over the year was the recovery across those small cap space, especially the small ords total return. That was up about 22%. And early in 2025, performance was quite concentrated in those mega cap AI leaders, not like Nvidia, Microsoft, and Alphabet. But as valuations became stretched, the investors became more selective, and we saw clear AI interest fatigue, and that movement led to a shift towards those smaller caps, especially in Australia, where we saw the major banks like Commonwealth Bank. They lost momentum as investors questioned whether a company with little growth prospects would trade at such high PE multiples of close to 30 times.
Yeah, and it was lovely to see that small cap cycle shift away from the large caps, where the ASX 20 especially dominated post COVID for a couple of years. So yeah, beautiful to see that shift to small caps. But
Mm.
commodities also, Kien, were another defining feature, especially gold, where gold regained its role as a portfolio anchor, as a real defensive anchor, supported by central bank demand, geopolitical risk, and inflation proving more persistent than expected. Our exposures to high quality gold producers like Newmont, Evolution, Northern Star, and many others helped our portfolio outperform over the last 12 months, Kian.
Yes, stellar run for gold. And beyond gold, though, we also saw other metals like copper is
Mm.
benefiting from electrification, while lithium also recovered strongly from stronger than expected EV sales and battery demand across data centers. So the move was also compounded by the fact that a lot of these hedge funds had to cover their short interest positions in the sector. So, that's been a stellar run for the lithium sector.
Yeah, and earnings resilience underpinned much of this during 2025 too, Kian.
Mm.
Growth remained positive, margins generally held up, and disappointments were more stock specific, not systematic. In
Mm.
fact, earnings trended higher over the last few months despite the correction in markets. You can see this on the chart on screen, comparing the All Ords index in the black to the 12-month forward earnings expectations in orange.
Yeah, quite a stark contrast there,
Mm.
Tim. And that backdrop also supported an active M&A environment, with many of the star stocks benefiting from acquisition interest this year. These included mining software business RPM Global, which we had as a star growth stock, automotive parts software company Infomedia, They were taken over. Oil producer Santos had a takeover bid. Insurance broker Ozbroker, similar. Animal feed company Ridley Corp. They took over a major company, and also gold producer Gold Road Resources was taken over as well, Tim.
Mm. And of course, we can't overlook the large acquisitions announced this year by logistics software leader WiseTech and building materials group James Hardy also. For investors, big deals like these warrant close scrutiny, especially given that they tend to dilute financial health and return on equity, leaving shareholders exposed to higher risk.
That's right, Tim. And given that we use a quant-based investment approach as well, it's also interesting to understand what factor styles performed well over the year. And momentum and growth strategies, they performed quite well on the back of interest rate expectations coming down, greater confidence in the soft economic landing as well. But meanwhile, we had quality and large cap stocks. They actually lagged on valuation concerns. But of course, with quality, when quality underperforms, it creates opportunity.
It sure does. Yeah. If high
Mm.
quality businesses want to be oversold or have a patchy period, it sure does create opportunity. But as a collective, our star stocks, especially our star growth stocks, they had a terrific year and they're up around 15% for the calendar year compared to 7% for the All Ords. So significant outperformance there. So even though quality may have been down a little bit, the collective star growth stock universe had a terrific year, especially there with so many gold stocks contributing to the great performance. This marks a second consecutive year of outperformance for star growth stocks and takes the success rate of star stock outperformance to 87% over the last 31 years. So an amazingly consistent track record there. So when it does have a negative year, you just got to ride through it knowing the probability of a successful year will follow. And for income investors, it was a year of outperformance for our star income stocks also, which was up around 9%. The lower interest rate environment helped recovery of the REITs and utilities and retailers. And now to Under the Microscope again. And this week we're having a good look at Telix Pharmaceuticals, a company that's become a textbook case study in why financial health is critical, especially in growth-orientated investing. Telix operates in radiopharmaceuticals, combining radioactive isotopes with targeted molecules to diagnose and treat cancer, with its flagship product, Illuccix, used to image prostate cancer.
Yeah, for a time, Tim, the investment thesis worked extremely well. Illuccix, it gained FDA approval, revenue surge, and Telix transitioned from a speculative biotech into a highly profitable business. And last year, return on equity peaked around 35%, and the company was able to generate strong margins while funding a promising pipeline across prostate, kidney, and brain cancers.
Yeah, but over the last year, cracks certainly started to emerge, didn't they?
Mm.
Financial health has deteriorated into early warning signals. A series of acquisitions, while strategically sound, have materially pressured the cash flow ratios, driven by rising current liabilities, higher tangible assets, and sharply elevated R&D spend. Telix remains heavily reliant on Illuccix for commercial income while funding an ambitious and expensive pipeline.
And that strain is now showing up clearly in the performance metrics. Return on equity has fallen to around 7%. Net profit margins have compressed to just 3.7%. And in the past 3 months, forecast earnings have been cut by over 40%. So looking ahead, consensus now expect return on equity to turn negative based on 13 analyst coverage.
Yeah, well, that gives us some confidence in those forward-looking numbers with the 13 covering analysts, Kien.
Mm.
Unsurprisingly, the share price has reflected this shift, though, too. Telix is down more than 50% over the last year, and short interest has risen above 10%, which signals growing skepticism around near-term execution amongst more the institutional investors. But also risks also around regulatory elements and balance sheet pressure.
And Tim, while the stock now trades at a steep discount to fair value, that weak financial health means it's potentially a value trap. And that said, One positive remains, though, founder and CEO, Dr. Christian Berenbrick, he's still in charge and retains a 6.4% stake, ensuring alignment.
No, that's one positive, Kian, but even compelling medical breakthroughs can't outperform deteriorating fundamentals. Until cash flow stabilizes and balance sheet risks improve, Telix remains a cautionary example of why financial health should never be ignored. And with all of the speculative elements now around the stock because of its poor health and poor metrics, it is classified as purely a speculative investment. So if you really do believe in the story or love to have a specky in your portfolio, then stop losses are certainly recommended. And a question of the week, Kian, and it's the $1 million question that always comes up this time of year. What should investors and members expect from the market in 2026?
Well, Tim, that is a $1 million question, but overall, the backdrop remains quite encouraging. As highlighted earlier, earnings trends have been broadly positive, particularly following the AGM season, and key leading indicators such as company forward orders and consumer confidence. It's been improving as well, helped by interest rate cuts. At the same time, market valuations have eased back in recent months, which has taken some pressure out of equity prices. And from an earnings point of view, though, the outlook is still constructive. Consensus forecasts for financial year 26 point to modest but positive growth across most sectors. Industrials and REITs are expected to grow earnings by around 5%, with growth for the banks slightly more subdued at around 2%. But it's the resources sector that really stand out for FY26, with the forecast earnings growth of around 10%, reflecting the movement to hard assets on the sticky inflation theme. Overall, market earnings are expected to grow by around 6%, so overly positive.
Yeah, I mean, it's such an unpredictable asset class, isn't it? So it's a bit of a guide there, but anything can happen. And on the chart, I love to see that our star growth stocks are forecast. Remember, forecasting is very difficult, but they're forecast to deliver much stronger earnings growth with the median growth rate of around 17%, which all in all is very, very positive. But
Mm.
we need to remain very agile with the markets, as we know, because as I said, it's very unpredictable, especially as we've experienced over the last 12 months or so. Ultimately, earnings forecast too, can change. So at a portfolio level, investors should stay focused on the fundamentals, bottom-up stock picking. That's what we do, and that's what we love, and we really encourage you to do the same. Particularly the financial health and quality of the businesses you own. Make sure that that quality is always in place. The recent market pullback has created a bit of an opportunity, allowing investors to rotate out of some of the weaker or financially stretched companies and into high quality stocks that have been oversold. And some of our star growth stocks are now over 30% from their previous highs, which represents good, strong opportunity. Well-established businesses of the like of Pro Medicus, Technology One, Ariscat, REA Group are some of the examples that are well off their previous highs. However, with reporting season not far away either, just be a little bit careful relative to the window of opportunity that it still exists to buy into oversold. Perhaps if they're due to report in the next couple of months, then we should just wait and make sure that the results that come through still warrant further consideration. All right, Kiam. Well, a really good Christmas edition of Taking Stock. I think with most of our core messages and we're bundled in there in order to allow our members to go away at Christmas time and have a look at their portfolio stockings and make sure they're full of great businesses in 2026.
Yeah, and thanks, Tim. And I wish all our members a safe and festive season as well. And even with the year coming to an end, we will still have our analysts available to help answer any questions you have on the stocks and the market.
Yeah, always great sitting down with you. Thanks for you and your team for all of your contributions during the year and the wonderful support you provide to our members too, Kian.
Thanks, Tim.
Yeah. All right. So yeah, as I said, I think all of our key messages have been bundled up into this recording. Remember that 15 stock diversified portfolio relative to your objectives, really, really important. Block out the noise, super important. Bottom up stock picking, that's what we specialize in. And it's worked, as you saw in a lot of the star stock performance metrics. It's worked over the last 30 years, and we expect it to keep working into the future just by keeping the complex simple. That's what it's all about. So all enjoy Christmas, stay safe. Enjoy quality time with family and friends, and we can't wait to see you all in 2026. Also, just a quick reminder that we've got our Christmas campaign at the moment. So any family members who you think would benefit from Stock Doctor or friends, then tell them to jump on our website and take advantage of our wonderful Christmas offer. All right, take care, everyone. We love servicing you and can't wait to continue to support and service you in 2026. Goodbye for now.